Look, $1 million is the universal retirement number, and most people think getting there is about picking the right stock at the right time. But the truth is far more boring and much more difficult, because for the first 10 years of your journey, compounding is going to feel like a complete scam. You are going to put in the work, you are going to save your money, and you are going to look at your account balance and wonder why it is moving so slowly. The reality is that there is a specific threshold, usually around $300,000, where the math of your life completely changes. Before that number, you are the engine and your paycheck is the only thing moving the needle. After that number, the portfolio takes over, and for the first time, your money starts doing more work than you do. In this video, I'm going to show you exactly why that $300,000 mark matters so much and how to survive the psychological trap of the early years. I have spent years working at a Fortune 500 company, and I see people making huge salaries who will never be wealthy because they do not understand this curve. They get to $100,000 and they think they have made it, so they buy a new car or upgrade their house and they reset the clock. They interrupt the compounding right when it was about to get interesting. Let us start with the basics of what a market crash actually looks like, because we are living in a time where everyone is calling for the next big drop. Whether it is the AI bubble bursting or oil prices hitting triple digits, there is always a reason to be afraid. A stock market crash is generally defined as a decline of more than 20%. Anything less than that, around 10%, is just a pullback or a correction. If you look back at the last century, we have seen over 13 events where the market dropped more than 20%. On average, these crashes cut stock prices by about 35% and last about 18 months. The recovery usually takes another 2 years. That sounds terrifying when you have hundreds of thousands of dollars at stake. When you see your account drop by $60,000 or $100,000 in a few weeks, your lizard brain goes into protection mode. You want to sell everything and move to cash or buy gold and wait for the storm to pass. But that is exactly how you lose, because in order for that plan to work, you have to be right twice. You have to know exactly when to get out, and you have to know exactly when to get back in. There is nobody in history who has done this consistently. Even the smartest PhD economists with billions of dollars under management fail at market timing. Take the example of fund managers who correctly predicted the 2008 crash. Many of them stayed bearish for the next decade, missing the entire bull market and losing their investors billions in potential gains. They were right once and they thought they were geniuses, but the market proved them wrong for the next 15 years. The lesson here is that you cannot predict the future moves of the market regardless of your qualifications. Investing is the art of being paid to take on uncertainty. If there was no risk, there would be no reward. The reason you get an average return of 10% a year from the S&P 500 is because you are willing to sit through the years where it drops 20%. Personally, I am fully invested and I have a significant amount of my net worth in the market right now. If a crash happens tomorrow, my plan is very simple, which is to do absolutely nothing. I have built my portfolio on a foundation of low-cost index funds like VU and VTI. I am not betting on a single company or a single sector to save me. I am betting on the long-term growth of the global economy. My strategy is built on 3 key principles that I want to share with you. Step 1 is having a clear plan for financial freedom. If you do not know why you are investing, you will be easily shaken by the news. For me, the goal is to reach a point where I can do whatever I want, whenever I want. When the market drops, I go back to my spreadsheet and I remind myself that my timeline is 30 years, not 30 days. Step 2 is to invest like you mean it by covering your basics first. This means having an emergency fund and paying off high interest debt before you put a single dollar into a volatile asset. You should only be investing money that you do not need for at least 5 to 10 years. If you need that money for rent next month, you are not an investor, you are a gambler. The goal is to be in a position where you never have to sell your shares during a downturn. You only lose money in a crash if you sell at the bottom. Step 3 is to ignore the noise and focus on what you can control. You cannot control the Fed or the oil prices or the war in the Middle East. But you can control your savings rate and your reaction to the headlines. I find it strange that people want to change their entire life strategy based on a news report. If you changed your career every time you had a bad day at work, you would never get anywhere. Investing is the same, and you have to be willing to be bored. The real damage from a crash is not the loss of value on paper, but the psychological damage that leads to bad decisions. Let us look at the math of why staying invested is so vital. A JP Morgan study showed that if you missed only the 10 best days in the market over a 20-year period, your returns were cut in half. Those 10 best days usually happen right in the middle of the worst crashes. If you are sitting on the sidelines waiting for things to feel safe, you are going to miss the recovery, and the recovery is where the real wealth is made. Now let us talk about that $300,000 threshold at the beginning of your journey when you have $10,000 at 10%. Return is only $1,000. Your monthly contribution is probably 5 times that growth. You are doing all the work, but when you hit $300,000, a 10% return is $30,000. For most people, that is a massive portion of their annual savings. Suddenly, the market is matching your effort dollar for dollar. This is the moment where compounding finally starts to feel real, but it is also the moment where the stakes feel the highest. Losing 20% of $10,000 is a $2,000 drop, which is annoying but manageable. Losing 20% of $300,000 is a $60,000 drop. That is a whole year of salary for many people disappearing in a month. This is where the average retail investor panics and sells. They think they are protecting their wealth, but they are actually cutting off the legs of their compounding machine. The years immediately following the $300,000 mark are the most explosive years you will ever have. If you can stay disciplined through that phase, you are almost guaranteed to reach $1 million. I look at my own investments every month and I share them with you on this channel to show that consistency is the only secret. I am starting a new portfolio this year despite all the global uncertainty. Why? Because there will always be a reason to wait. In 1950, the world was full of chaos, but £1,000 invested then would be worth millions today. The best time to start was 10 years ago, and the second best time is today. Stop trying to be the smartest person in the room and start being the most disciplined person in the room. The market is a machine that transfers wealth from the impatient to the patient. I want you to be on the receiving end of that transfer. We are building a community of young investors who understand that wealth is a long game. If you are worried about the AI bubble or the cost of living crisis, remember that the best companies always adapt. They have survived world wars and pandemics and high inflation. By owning the broad market, you are betting on human ingenuity. That is a bet I am willing to take every single day. Keep your eyes on the prize and do not let a red day ruin your decade. If you found this helpful, leave a like and subscribe to the channel. I am sharing my journey every single month to help you stay on track. Check out the video on screen now to see exactly how I am building my brand new portfolio from scratch. The road to $1 million starts with a single dollar and the discipline to leave it alone. I will see you in the next one. And as always, happy investing. Remember, I am not a financial advisor, and this is for educational purposes. But the math does not lie, and the math says that time in the market beats timing the market every single time. Stay focused, stay disciplined, and let the compounding do its thing. We are going to get to that $1 million finish line together. It might take 10 years or 20 years or 30 years, but as long as you do not stop, you will get there. The only way to fail is to quit, so do not quit. I am proud of the progress we are making as a community. Let us keep stacking and keep growing. The future belongs to the ones who can stay calm while everyone else is panicking. I will talk to you soon. Stay smart with your money. The world is full of noise, but your plan should be silent and steady. That is how you win. I am signing off now, but I will see you in the comments. Tell me what your target number is and how you are handling the current market volatility. Let us support each other on this path to freedom. Take care.